Inflation finally hit. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming in hot, futures fall as producer price inflation unexpectedly rises by the most in 3 years. From industrials to tech to retail, we'll dig into what the latest corporate reports say about the state of the economy after earnings, and to the moon with Bitcoin. It briefly hit an all-time high, over $124,000 a coin as investors snap up riskier assets. Katie?
Let's talk about tractors, because Deere falling after trimming its outlook as customers remain cautious. And you also have lower grain prices preventing farmers from spending more money. You take a look at shares of Deere pre-market, currently down about 7%, Matt.
All right, and Cisco was out with lukewarm guidance last night for its AI progress. The outlook assumes that current tariffs remain in place at the levels that they are through the end of 2026. But of course, those could and likely very much likely will change. You can see Cisco shares down 2% in the pre-market. Katie?
We'll dig into that earnings report, but let's get back to this morning's eco data. U.S. wholesale inflation accelerating in July by the most in 3 years. ADP chief economist Mila Richardson spoke to Bloomberg Television earlier on the print.
This inflation surprise is something that should be considered with a whole bunch of other data that was leading up to this point, showing no smoking gun when it came to tariffs and inflation. So the big picture is it's an economy that continues to perform. It's just not as dynamic as we're used to seeing.
For more on the data surprise, we're joined now by Michael Ball. He is macro strategist for Bloomberg Markets Live. So you look through the details of this report. What sticks out to me is that it was this surge in margins. What does that say about who is actually eating higher costs here?
Yeah, it looks like it's still being split about third each way. So the actual people who are exporting are taking a good chunk of it now. Wholesalers then are starting to, accumulate what they have to add in. And then finally, it's going to push on to the consumer. And we're all waiting to see kind of how that trail goes and how long it takes to finally hit the end guy. Because we saw in CPI, it's really not going all the way to the end yet. No.
If you look at ECAN is a fantastic function on the Bloomberg terminal, ECAN Go. And you can look at this PPI report through that lens. It shows a huge jump in services, which I'm not exactly sure if I understand why services shows through in producer price inflation. Here's the chart, by the way.
Well, I mean, it's a good question. I think services still are the more sticky part of this. We still see a lot of discretionary spending there, and the consumer is willing to eat that up, and that's why it's being passed on. Now, to your point, we saw initially that a lot of the exporters took the initial hit from the tariffs, and then we saw the inventory builds. So there hasn't been as much pressure now for wholesalers to then absorb that. And that's going to change now as inventories come down, and effectively they're going to have margin pressures of their own that'll need to be passed on.
And it's interesting to look at this market reaction here. You see equity futures really plunge in reaction. You also have 2-year treasury yields rising right now because it feels like we had all coalesced around the idea that the Fed is going to cut rates next month. Some of that logic being questioned right now.
Yeah, I think yesterday's rally was very interesting, and it was a little bit of a continuation from this week's general theme where we are starting to price in a bigger September cut, a 50 basis point cut. Besson clearly was out on our show saying some things that indicated that that may be the pressure the White House is putting on the Fed again. But what happened is, of course, now with this, we have higher inflation again back in the forefront. We also saw Mary Daly from San Francisco Fed push back on that. And I think all that expectation is kind of the froth that brought into the market with small caps outperforming. We saw Bitcoin hitting new highs. All of that now has subsequently sort of faded in this morning's open. We'll see where it goes. Everything, things are minute by minute. We're getting lots of headlines. Besson did walk back those comments this morning, which were interesting because, again, Treasury Fed Accord was, again, talked about all night. We covered it in the MLive blog, and he crossed the line that we hadn't seen crossed in quite some time.
We're still seeing overnight index swaps pricing in a 95% chance of a 25 basis point rate cut. So in September, that hasn't fully unwound. Michael Ball of Markets Live, thanks so much for joining us. You can type MLIV GO to follow his work. Let's turn to the earnings news of the day. For that, we have team coverage across sectors, from industrials to tech to retail. Starting with Deere, the world's biggest farm machinery maker, cut its outlook again as demand dries up. Bloomberg's Michael Hertzer reports on farms and fleets. Michael, what do we know?
This year was supposed to be the bottom of the kind of farm economy, and we're starting to look for a rebound next year, but that's starting to look a little unclear now. We have a massive corn crop looking coming to us in the next couple of months, and China has not bought a single soybean from the U.S. for next season. So Deere kind of trimmed the top end of their guidance a little bit, and we're kind of waiting to see when farmers might start spending again. It was a hope to happen soon, and we will look to learn a little bit more details from Deere coming up on their call.
Yeah, and we'll see if that does anything to the stock, because currently down about 7% pre-market. Bloomberg's Michael Hertzer, appreciate the update. Let's switch to tech, because Cisco earnings, they came in line with Wall Street expectations, but the forecast seen as cautious by analysts. Bloomberg Tech co-host Ed Ludlow joins us now. And Ed, talk to us about this caution coming through and what that means for this company's stock.
Yeah, the story for Cisco is they're starting to see like real money from AI, $1 billion in the fiscal 25 year, but they're not also promising any sort of boom. So the outlook is being seen as cautious. And I think, Matt earlier said tepid, but the street also doesn't believe that there's going to be some kind of delayed growth from what's happening in AI. So the sales outlook is $59 to $60 billion for fiscal 26 through July. Consensus was 59.5 billion, so that's bang on. But as always in technology, there are corners of the street that has much more bullish forecasts. Cisco's involved in big projects. The Stargate version of that's happening in the UAE. They have a humane contract in Saudi Arabia. But no one expects any of that to materialize for some time. And Chuck Robbins and Cisco have pushed much deeper into security and services, software. But those elements also missed as well. One area that Cisco gets a lot of credit is how it's communicated about tariffs. So this outlook for fiscal 26 assumes that current tariff conditions as they are now carry on to that point at the end of the fiscal year. And the street likes that, because they're basically saying, well, at least Cisco's being honest. They just don't have the sexy AI story in the near term, nor do they brag about one either.
I also think it's interesting that this is was the poster child for overhype and overspend in the fiber build-out during the dot-com bust. Ed Ludlow, thanks very much. We will watch your interview with the Cisco CEO, Chuck Robbins. That's on Bloomberg Tech at 11 a.m. Wall Street time. Finally, in retail, Tapestry's outlook missed estimates as tariffs eat into margins. Bloomberg's managing editor for global business in the Americas, Shelley Banjo, has the details. Shelley?
Yeah, you've got a few stories emerging here with Tapestry that's pointing to some bigger themes going on in the rest of the industry. First is tariffs. They're starting to take a bigger hit. Companies that, the rubbers hit the road here. They're actually looking at how is this impacting our business right now. All of the things, all the inventory we built up beforehand is starting to run out, and we are trying to figure out what to do here next. But it's not just a tariff story for this company. They took a huge write down on their Kate Spade brand, and they're starting to see double-digit drops in sales of Kate Spade. Meanwhile, you're seeing Coach sales do pretty well for them. And so there is this bifurcation, or it points to this bifurcation in the market that we're seeing among consumers, where the higher end is doing much better than the lower end here.
And it's worth pointing out that Tapestry, prior to this print, was up 75% on a total return basis year to date. So there's certainly plenty of room to fall there. That is Bloomberg's Shelley Banjo with the latest on those earnings. Let's get a check on equity futures right now. We have just over 20 minutes until the bell rings. You can see the S&P 500 lower by about 0.4%, a similar magnitude when you take a look at big tech as measured by the NASDAQ 100. It's the small caps really bearing the brunt of the losses today, with the Russell 2000 down by 1.3%. Following that hot PPI print, the question that comes out of this is do we see this get passed on to consumers? When do these numbers that we're seeing at the producer level start to show up when it comes to consumers?
Yeah, absolutely. I think, my question to Michael Ball when he came on set here was, does this PPI number feed into CPI next month or the month after? It seems like waiting for Godot, right? haven't seen that tariff play through into consumer prices to any large extent. And it looks like what they're doing is they're making their suppliers pay some of it. They're eating some of it into their own margins, but eventually they're going to pass it on to you and me, Katie Greifeld.
Just trying to track that daisy chain of higher costs. Certainly investors, analysts, and economists, and everyone else.
Coming up, Apple is planning its big return to artificial intelligence. The details on the company's ambitious slate of new products. That conversation coming up next. This is Open Interest. Let's get now to high interest. Look what's making headlines around the world. U.S. listed shares of JD.com rising in the pre-market on better than expected earnings. The results getting a boost from government-directed consumer subsidies and an aggressive drive into new arenas. Remember, we're talking about a Chinese company here. Shares of Bumble getting hammered ahead of the opening bell. Sources telling Bloomberg that the company's CEO and Blackstone are offering over 18 million shares at a significant discount to yesterday's closing price. And of course, that doesn't bode well for existing shareholders. And Apple is planning its AI comeback, featuring a host of new devices, including robots. That's the exciting part, and other smart home products. That's the super boring part. Sources telling Bloomberg a tabletop robot that serves as a virtual companion is the centerpiece of the strategy, and I am very excited, Katie, to see this.
Well, let's talk about it with Mark Gurman. He broke that Apple scoop, and he joins us now, very early for him. So, Mark, we appreciate it. Let's talk a little bit about that tabletop robot. It's targeted for 2027, will feature a lifelike version of Siri. Is this the answer to Apple's problems? Because you're not seeing too much of a reaction in the shares right now.
Yeah, I don't think it's a long-term. I think it's a hardware answer. Obviously, Apple is a hardware company at its core. That's how they make their money. So they've been looking for some hardware-centric ways to bring artificial intelligence to life. How do you get people to pay for AI, so to speak? People are not really paying a lot of money for chatbots, right? But they will pay for AI hardware. And so this robotics initiative is one. The idea is to have a virtual companion in your space, whether that's your living room, your desk, or your kitchen, basically an iPad on a robotic arm that you can talk to it, it'll talk to you. If you have conversations, if you're having a conversation with a spouse, a friend, or a roommate, and you're in the vicinity of the robot, it could jump into a conversation. It can help you get tasks done throughout your day. It could help you with work. It could help you organize calendars. It could help you with media consumption. Basically everything Siri can do today, plus conversational ability.
I mean, I already pay $20 a month for ChatGPT, and I would much rather have Siri doing that because she could be integrated into the whole ecosystem that I'm and my family are invested in, right? So for me, getting Siri up to snuff is the most important aspect of this, Mark. How close are they to doing that?
It's really a stretch. Another thing that I get into in this story are the struggles that Apple has had with Siri. Now, as we know, these voice assistants, these AI projects, at their very core are large language models, or foundation models as Apple calls them. The Siri today uses Apple foundation models. Obviously, ChatGPT, they use OpenAI foundation models. Google has their own Gemini models. They all have their own models. The models are where Apple is struggling to some extent. And so what they're doing is they're taking a deep look at replacing the Apple models with third-party models. They've talked to OpenAI. They've held very advanced conversations with Anthropic to use Claude models. My belief is the sooner that Apple abandons its models and goes with third-party models that are obviously extraordinarily proven, that's why we've been talking about AI for the last 3 years, right? The closer they'll get to releasing a product that consumers are going to be able to use, enjoy, and want to pay for. You know, most customers, they don't care how the technology works. They just want it to work. And so that's what Apple's taking a very close look at right now.
Yeah, that's a very fair point. I want to talk about the other portion of this story that you put out yesterday. That is home security. Matt mentioned that was maybe boring, but he also mentioned the ecosystem that he, and it feels like many other people, have invested in. And when it comes to the home security portion of this is all part of Apple trying to make that ecosystem much, much stickier.
Yeah, to your point,
Oh no, Mark.
Mark is frozen.
Come back.
I feel like Apple needs to make a good router, you know, so that we could, because whatever gear that Mark's using, I'm going to say Cisco.
It is very early on the West Coast. I don't know. Maybe the gremlins got in there. But
let me just say that I think, so I don't mean to say the home stuff is super boring, but these speaker products don't seem to have caught on with everyone yet, and certainly not the one from Apple. That will be greatly helped if they develop a better Siri. And frankly, for me, I would be happy if Siri just used ChatGPT. I don't care who provides the LLM, as long as it's her voice on the Apple products. The other really interesting thing is blood oxygen tracker coming back, and if they can crack the blood pressure issue on watches. Like, you're a Garmin gal.
I am a Garmin gal.
But I imagine if Apple would come out with a watch that tracks your blood pressure as well as your blood oxygen, you might be tempted to switch over.
Well, we have some breaking news. I think Mark is back with us. And Mark, let's talk a little bit more about blood, because news coming out this morning, Apple introducing a redesigned blood oxygen feature for some Apple Watch series out there. What does this mean for Apple overall in the entire landscape of their product universe, which we've been talking about?
So here's the story. 2 years ago, Apple was sued by a company called Masimo over patents related to blood oxygen saturation. Apple, a few years ago, launched the blood oxygen app for its Apple Watches in the US and elsewhere. The US Customs Agency made Apple pull the feature at the end of 2023 from new models sold in the US. So what Apple is doing now, because of a new US Customs ruling this week, is a workaround. The sensors will be able to capture that blood oxygen data, and you'll now be able to read that on your iPhone. So the Apple Watch blood oxygen app is still not going to work, but at least you're going to get that data. So it's a clever workaround, and it's very important. In less than 1 month from now, Apple will be introducing the new Apple Watch models, a new Series 11, new low-end SE Apple Watches, and a third-generation Apple Watch Ultra. And now they're going to be able to market those watches as including blood oxygen in the US for the first time in 2 years. So this is a huge and significant development for Apple's health efforts in the US.
Mark, when will they be able to give us blood pressure readouts from the Apple Watch?
You know, they've been working on that for some time. They've targeted 2024. They've targeted 2025. There have been some regulatory issues, patent issues, measurement issues. You know, we had a story this morning out about Whoop. If either of you use a Whoop, those are those screenless but very popular wearable devices that have been out for quite some time. They added a blood pressure tracking feature actually in May. The FDA sent them a letter a few weeks ago saying, this does not qualify. Your watch is not regulated. You can't do this. We put out an article this morning saying Whoop is refusing to remove the feature. So there are a lot of regulatory concerns when it comes to blood pressure on the wrist, and I think Apple's still trying to figure that out. But in a little bit under a month, we'll see if they ended up getting it to market this year.
Got it. Really cool stuff. Mark, thanks so much for joining us. Bloomberg's Mark Gurman talking to us about the Apple promises. We'll see if they deliver. Coming up, New York Life's Lauren Goodwin says the rally in stocks is sustainable until policy effects show up in the economic data. Are we seeing that this morning?
That's
with
the question.
PPI.
We should ask Lauren about it next. This is Open Interest.
I don't think that cutting interest rates is going to solve these problems. All cutting interest rates are going to do is try to inject what we have with steroids, and it's just going to produce more inflation.
That was Jim Bianco of Bianco Research speaking on interest rates and inflation. And let's keep that conversation going now with New York Life Investments economist and chief market strategist Lauren Goodwin. Lauren, great to have you with us. I want you to put on your economist hat right now because we need to talk about PPI. Coming in hot at 8:30 this morning, seeming to suggest that companies are passing along higher input costs related to tariffs, import costs, that is. We didn't see that necessarily in the CPI. When do we actually start to see that show up?
Well, good morning, Katie, and hi to Matt as well. Thanks so much for having me on what is turning out to be a fascinating macro day. This PPI data, I don't see it as necessarily mistimed with the CPI data. I think we were already beginning to see the impacts of these higher producer prices in the consumer prices we saw on Tuesday. And the reason I say that is that investors have gotten used to the idea of thinking about tariff impacts related to goods. What we saw on Tuesday was stickier prices in services, especially related to areas of medical services and transportation. Those are the very areas of the economy that are impacted by the price increases that we've been seeing today in the PPI data. Trade, warehousing, really everything except for energy is seeing pretty significant cost pressures as a result of trade and tariffs. And so I think these price increases are already here. And probably most importantly, it's going to be difficult to assess what we maybe would have relied on. How does trade impact goods relative to how does the economic cycle impact things like services? We are seeing trade impact to both sides of the data here.
Lauren, I got to ask you about Scott Bessen's comments yesterday on surveillance that any model shows that Fed funds rate should be lower by 150 to 175 basis points. John Authers today says this is breathtaking. He says that with current effective Fed funds rate at 4.3%, Bessen is suggesting it should be around 2.6. Over the past 70 years, the rate has never been that low, with inflation as high as it currently is. We had core CPI at 3% yesterday. So apparently any model now shows the U.S. monetary policy has been misguided throughout that entire period and needs to be changed. What do you think as an economist?
Well, for starters, I have to congratulate Anne-Marie and Jonathan on that interview, which was fantastic. Such an interesting interview. And when it comes to the neutral Fed funds rate, it's a matter of hot debate among economists, really any time in the economic cycle, but times like these are so much more interesting. I think regardless of where inflation is today, we have to think of the neutral rate related to,
Lauren, let's pick it up on the other side of this break because we have the opening bell coming up. This is Bloomberg. We are moments away from the start of trading on this PPI Thursday. This is Bloomberg Open Interest. I'm Matt Miller. That inflation number came in hot this morning, and that's driving markets down. It's not dramatic. Honestly, from an all-time closing high yesterday, I think we were at 64.46 or something unbelievably high on the S&P. We are down 1/3%, so not much. A little bit more than that on NASDAQ futures. The Russell taking the biggest hit, right? Because they're the most worried, those small caps, about cuts. They want to see 50 for sure, and 25 maybe a disappointment for them. You have... oh, he's trying to whistle, which is cool. I hope that actually worked. This is like a Miami Stock Exchange kind of thing listed on the New York Stock Exchange. That's a little bit weird. I'm going to dig deeper into that. And then you have Dominati Holdings ringing the bell at the NASDAQ. It really doesn't matter because we're watching what happens to stocks when inflation finally comes in hot and a little bit of disappointment in earnings.
Yeah, especially when it comes to Deere. Deere falling after trimming its outlook as customers remain cautious. You also have those lower grain prices preventing farmers from spending. Deere, you add it all together, Deere is down 6% at the opening bell. This is disappointing because this is a company that had been building a bit of a rebound year to date, up about 22% through yesterday's close, falling 2 tepid years in the stock market, but coming a little bit closer back to earth right now, Matt.
I love the word tepid. I'm going to use that for Cisco's guidance as well on AI progress. The company came out with earnings, actually some pretty strong numbers, but the outlook concerns the market. It also assumes that current tariffs remain in place through the end of 2026, and you know what it means to assume, right?
Yeah. I won't say it here, but yes.
I think you probably could, but I won't either. We're back with New York Life Investments economist and chief market strategist Lauren Goodwin. And Lauren, I'm sorry I had to cut you off into the break because the big news of the day is the PPI. The big news of the day is inflation. That looks like it's finally coming through to some extent from tariffs. Not shockingly high, but the core number was 3.7%. And Scott Bessen thinks, and frankly, the market thinks as well, that rates should be lower than 3%. That's what we have overnight index futures pricing in for, towards the end of 2026. Where do you think the neutral rate is?
Right now, I believe that the neutral rate is closer to 3.5, maybe 375. So let's call it 75 basis points lower than it is today. And that's a function of several things. We've seen a major development in the economy related to artificial intelligence that's making the investment cycle much more capital intensive. And that's only reinforced by some of the longer term structural themes related to climate resilience, infrastructure, some of the spending that's happening globally. And so this is an environment where governments, while they're trying to spend less, are going to be forced to spend more on rehashing their economic and physical security. That's an environment where I expect the neutral rate is a little bit higher than what we're hearing from policymakers today.
Let's talk about how you invest around that, starting very broad. You mentioned the countries are going to have to spend more to maybe juice their economies a little bit more. Are those the countries that you want to be investing in?
We're taking a very asset allocation broad approach when it comes to investment strategy right now, because with valuations where they are, especially in the US, I think you have to be patient. And I think that you have to be transition oriented. And so as we think about, let's start with the international story, the way you asked, there are different benefits, let's say, of the strengths of different countries in an environment like this. Technology, still a major strength of the United States and a source of reliable earnings for investors in U.S. equities. And so we see the growth equity in the U.S. as being particularly beneficial. If you look in Europe, it's a completely different story. Faster interest rate cutting cycle, benefiting cyclical sectors like financials and industrials, where those countries tend to be stronger and more entrenched. So we're actually seeing value equities performing much better there. And so taking a global approach like that, we think, is prudent for not just diversifying, but also capturing the areas of the cycle that are transition oriented the way that we think is intelligent.
You know, we had an MLive Pulse survey yesterday that showed, number one, markets love that Trump is trying to push rates down, and they don't care if he just puts a yes man in the seat, and that's how it works. And number two, markets think that the U.S. to rest of world valuation is going to continue to shrink. I think those things are related, Lauren, because this administration seems to me to want to weaken the dollar further, which may be good for our exports, but is going to be great for international stocks. Is that spot on?
It's part of the story. Dollar depreciation does help the earnings in U.S. dollar terms that come back here to the U.S. to U.S. multinationals. I think it's one of the reasons why we've seen a little bit of buoyancy in U.S. earnings this quarter or in Q2 relative to what we might have expected. But getting to the first point that you mentioned related to markets wanting the policy rate to move lower. In the near term, I expect that that's the case. We tend to see markets perform better when short-term interest rates move lower. But a big part of that story is many, many years, even decades, where Fed credibility hasn't particularly been in question. And it isn't in question yet. But if I think we saw political pressure related to policy interest rates, we may actually see long-term interest rates move higher. And the reason I say that is that if inflation expectations become de-anchored, something that hasn't been much of a problem in this cycle, but could become a problem in the case of political interference, then your things like mortgage rates, business borrowing rates actually move higher, even as the policy rate's moving lower. I don't think that's what the markets want to see.
It's interesting, that point that you're making, that if we start to see that political influence, that'll pressure long-end rates higher. I hear that as part of the logic for why some folks here like steepener trade. So let's talk about the first front of that trade, what's going on at the short end. It feels like people are just continuing to pile into shorter dated bonds, including paper, including the likes of money market funds. It just seems like that is a trend that will not be broken, Lauren.
So one of the reasons why I see this trend persisting has less to do with what's happening at the short end of the curve, because that would actually discourage investors piling into money market funds or even short duration bonds. If that is cutting, then you're potentially getting less income in those areas of the market. This is really about risk. See investors that with facing valuations in equities that are high, that might be looking to build some resilience. But where we like to be is staying invested in bonds, But there too, there's an element of short duration that makes sense. Again, less about interest rates and more about, if I think about the default horizon for a company, in the next 2 years for US publicly traded credit, I am not concerned about a meaningful uptick in the default rate. I might be concerned about credit spreads widening, but when it comes to the ability of these companies to pay their debt, to pay a coupon, I'm not concerned about that. And that's an interesting income generation opportunity.
Yeah, absolutely. Even with spreads super tight right now. Lauren, we have to leave it there. Always great to speak with you. That is New York Life Investments economist and chief market strategist, Lauren Goodwin. Meanwhile, we're just about 7 minutes into this trading day, so let's get a check on this stock market. Only down about 0.2% on the S&P 500. But what's interesting here is that breadth is super bad right now. You only have 66 names in the green, well over 400 in the red right now. The companies that are trying to move higher today, you have Amazon, Apple, Netflix in the gainer seat, but very small moves overall. Take a look at the downside. This is where things really get interesting. Nvidia lower by just 0.5%, but this company is so big that that is your biggest weight on the index. Deere, we know that they delivered some pretty disappointing earnings. You can see that reflected in the move today. Tesla, Meta, Home Depot, Tapestry, the list goes on. So this bad breath, you're going to see it when we look at sectors as well. You have one lone gainer today. That is consumer discretionary. But take a look at all this red. Right down at the bottom, industrials, real estate, and materials fighting for biggest loser today. Materials currently in that position, down over 1%, Matt Miller.
All right, so some pretty decided moves to the downside coming, I will repeat, though, from an all-time high at the close yesterday. When we come back, we're going to talk about Bullish, speaking of, extending gains as the crypto industry celebrates another stellar IPO, and Bitcoin at $125,000. This is Open Interest.
Welcome back to Open Interest. Let's take a look at this stock market right now. The S&P 500 down less than 0.3%. We were down more when it came to the pre-market in reaction to that hot PPI data, but you can see that this is a market that maybe wants to go green, and we're just about at record highs. The NASDAQ 100 a little bit closer to positive territory right now, but the small caps really in the hurt locker. The Russell 2000 down about 1.3%. As Matt said at 9:30, this is an area of the market that really wants to see rate cuts. So some enthusiasm really coming out of the little guys this morning. But let's get to our top calls. Some of the analyst action in focus this morning. And first up, Bank of America upgrading Dow Chemical to neutral, saying that the current setup is clearly more favorable after recent declines. But you can see shares down a little bit this morning. Next up, Argus downgrading eBay to hold. The analyst seeing limited upside after gaining 30% since its last earnings report, down about 2%. And finally, we have Baird upgrading CVS Health to outperform, growing increasingly confident in the company's turnaround strategy. Shares up a little bit this morning, Matt.
All right, CVS up 1% this morning in a down market. So that does mean something. Let's turn to crypto right now. Bullish is still climbing after its IPO yesterday, and it almost doubled at the close. Let's discuss with Bloomberg's Bailey Lipschultz, who's been following the stock. Bailey, I think, first of all, you got to tell everyone what it is, because not everybody knows.
Not everybody knows, Matt. This is a company that operates an exchange catering to institutions, so their pitch is not to necessarily compete with the Robinhoods or the Coinbases of the world that are in retail traders' pockets through their phones, but really trying to partner up with some of the big banks, trying to push this notion that the future of finance is on the blockchain and is related to crypto. They also own CoinDesk. They have a few $1 billion worth of Bitcoin on the balance sheet, but really kind of a broader approach, trying to lean into kind of the institutionalization of cryptocurrencies and throughout that piece.
It's a really interesting distinction, because you have to imagine that the crypto retail space is pretty crowded at this point, but institutions, maybe there's some white space there still left. Talk to us a little bit about how this IPO was received. Clearly there was a one-day pop, and you can see it continuing this morning.
Yeah, Katie, there was a lot of excitement, at least from the buy side, about getting their hands on and getting allocated more shares in these newer cryptocurrency or cryptocurrency adjacent companies. We've seen kind of limitless demand for the likes of a Circle, which is up almost 5x from its IPO just a number of weeks ago. So when you look at this, over 20 times oversubscribed, talking to the CEO yesterday, they actually kind of bragged about the fact that they allocated about 20% of the book to retail traders. Using things like SoFi, Robinhood, and other kind of wealth managers, if you will, kind of like pointing to their underwriters. But this is definitely an area that investors right now, in a market that seemingly is only going up and to the right. I know you mentioned we're a bit off those all-time highs, but with Bitcoin rallying, investors want their hands on some of these assets, and we're getting ready for what could continue to be a hot summer or hot start of the fall post Labor Day, with more crypto companies, crypto adjacent companies filing and launching those IPO processes.
It seems to be the right time. I mean, yesterday, two of the president's children were at the NASDAQ ringing the bell for some crypto-related issue. And, you know, normally when the president's family tries to make money with other ventures, they hide it. Now they're coming out in the open. We've got this legislation that's come through for stable coins. As you mentioned, Bitcoin at an all-time high. Is this company just going to be an exchange? Do they make money on, I know they own CoinDesk, or is it going to be a Bitcoin treasury deal like Michael Saylor's strategy?
The company CEO said, for all intents and purposes, they, by definition, are a Bitcoin treasury company, but they have no intention to sell shares, sell convertible debt, a la Michael Saylor's MicroStrategy, now known as Strategy. They want to really be a part of the institutionalization of Bitcoin. So they are talking about, you know, having these indexes that maybe can lump together the top 10, 50, 100 tokens and being kind of an exchange in that, a la MSCI, kind of trying to partner with some of those more traditional financial institutions and trying to bring it more broad as it relates to their exchange business. Talking with the CEO, they didn't rule out the fact that they now, as a public company, will have more currency, whether that's through selling shares or selling debt instruments, to be accretive in terms of striking M&A packs. But they definitely right now, according to the CEO, want to focus on organic growth, and they see a lot of blank space going forward. But as you mentioned, a number of companies in the crypto space leaning into that trade, leaning into the enthusiasm around it. And it does seem like, at least as it relates to convertible story, investors can't get enough of these convertible instruments and these preferred shares coming from Michael Saylor's strategy and other companies kind of me too, me threeing that.
All right, Bailey, thanks very much. Bailey Lipschultz talking to us about the IPO of Bullish and really the rise of crypto behind it. Coming up, we're going to talk about a number of heavy hitters in the semiconductor space. They report after the bell, and we'll take a look ahead with Cantor Fitzgerald's CJ Muse. This is Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what happened to stocks after the PPI number came out hot. You do see a bit of a drop here. It's not really that sizable. We're still at 64.56 on the S&P after closing at a record high yesterday. The NASDAQ right now is unchanged. The Russell 2000, the small caps and the mid caps faring the worst because they're the ones that need rate cuts the most. But we're still pricing in almost one full cut in September if you look at WIRP Go on the terminal. NVIDIA is up 0.25%. We're going to talk about chips with CJ Muse in just a second. And Apple, after its news yesterday, although that did come out before the opening bell, also getting a bit of a boost here in a down market. You had disappointment with JD.com. Deere, a bigger disappointment, down almost 7%. Cisco had a tepid outlook, and the shares are tepid today. And then AMAT right now down 1%. Let's talk about, Katie, some chip makers after the bell.
Yeah, let's do that. And we have a great guest to do that with. Cantor Fitzgerald, Semiconductor Analyst, joins us now, CJ Muse. And CJ, let's start with Applied Materials. That is obviously a big company coming after the bell. Interesting to hear a little bit about the numbers themselves. Also, they recently announced a $200 million investment in Arizona. What's your expectation for what we hear from the executives on the call?
Yeah, good morning, Katie. Thank you for having me. I think for Applied Materials, they'll echo much of what we heard from their peers, Lam Research, KLA. So I'm looking for a small beat and raise. And I think that is widely expected by the market. I think China will obviously be a core area of strength into the October quarter guide. And I think the real positive catalyst to look for are signs of a pickup in their Samsung business, which I think will absolutely occur. But, I think visibility into that might be a bit early now. So, I think that tonight's report will be, in line with kind of buy side expectations, which, will be good enough given the current valuation.
CJ, we saw, I know this isn't necessarily chips, but we saw kind of a tepid outlook from Cisco in terms of the AI investment, and I always think back to how much they spent to lay fiber down in the .com bubble and then burst. Do you see any of that, overinvestment, overhype in AI right now leading to problems down the road, or are we going to see a return on investment from this stuff?
I mean, there's a lot to unpack there. I'd say that, some of their peers like Lumentum put up big numbers. And so I think it might be just timing wise from a Cisco perspective. And then if you take a big picture view on AI, I think you're seeing, real signs of positive returns on investments, whether, OpenAI and kind of the revenues that they're starting to talk about, as well as, the big hyperscalers and even kind of sovereigns, enterprise, and some of the folks who are looking at utilizing digital twins, Omniverse, as they build out factories. So I think it's there. And I would also say that I think we're still early, in the build plan, right? So when we look to NVIDIA reporting next week, they've told us that from wafer in to rack out takes 12 months. And so between that and their new product ramp late next year with Rubin, they have great visibility. And I think that, what we're going to learn in the next kind of 3 months is that this year is going to be a tremendous year for data center growth, and next year will only be stronger.
Well, let's talk a little bit more directly about NVIDIA here, because I feel like that's looming in the back of every conversation you can have about chips right now. Definitely a shocker at the start of this week, CJ, to see that the Trump administration plans to take 15% of the revenue that NVIDIA makes, and AMD for that matter, when it comes to Chinese chip sales. You didn't see too much of a reaction either way when it came to NVIDIA shares. I'm wondering how you are factoring this into how you're thinking about the company, because we know that NVIDIA, obviously, really, China is a very important market.
Yeah, no, so a lot to unpack there as well. So, I think number one, just first order effect, China's completely de-risked from the model, and therefore, any business there is just upside. I think the second order is that, half the world's AI engineers are in China. And I think the recent pivot in terms of re-granting licenses for the H20 and for AMD's product is a very positive sign, something I absolutely agree with, in that we want the world to standardize on a U.S. platform. And I think the alternative in terms of standardizing to Huawei is not something that we want. In terms of potentially paying an export duty of 15%. I'll let other legal minds discuss whether that is truly something that we can do. But more importantly, I think the concern I have is the net impact on China government and their willingness to allow their customers to purchase.
Absolutely, CJ. That's a great point. Running up against a hard break, so we got to say goodbye. Really appreciate your time. CJ Muse there of Cantor Fitzgerald. This is Bloomberg. We are 30 minutes into the trading day, and markets are lower.
Markets are lower. Breadth is much worse than 0.1% lower on the S&P 500 would suggest. More than 400 names in the red right now, Matt Miller.
All right, welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. And coming up, a surprising report. Producer prices rise more than expected, rekindling inflation concerns.
Up next, tomorrow's retail sales data will offer fresh insight on the consumer as the labor market shows signs of losing momentum.
And on the geopolitical front, President Trump presses President Putin to agree to a ceasefire as they gear up for their meeting. All of that and more coming up. But meanwhile, you have the bulls powering a melt-up for equities. Ed Yardeni discussed his outlook on Bloomberg surveillance.
Right now, I'm still kind of sticking with 6,600 on the S&P 500 by year end, because I think there's still a couple of indicators here that might suggest that maybe the Fed shouldn't be lowering rates. But absent that, we could go right back to 6,900, 7,000 by the end of the year on a melt-up situation. And the problem with melt-ups is they're followed by meltdowns.
Emily Roland, co-chief investment strategist at Manulife, John Hancock Investments, that's a mouthful, joins us now. Emily, you got to talk to the marketing people about, I think they could really tighten that up a little bit. But I want to talk about, I mean, look, Ed Yardeni is making the call that any of us could make. Markets will continue to go up throughout the course of time, but there will be points when they fall in between, right? The question is, are we right in front of one of those dips, one of those corrections right now, because we've shot up with what Alan Greenspan may have called irrational exuberance?
Yeah, I mean, the challenge, Matt, right now is we can't get much better than this sentiment-wise. The B of A fund manager survey suggested investors are the most bullish since February. You've got the S&P 500 right now trading at 22 times forward earnings. The highest we've been historically is 24. So there's a little bit of room for some more multiple expansion here, but not much. And then meanwhile, you've got sentiment and momentum being such a significant driver. The momentum factor is up almost 20% year to date. So that's just chasing recent winners. And, you know, it's hard to step in front of that right now. It's almost like stepping in front of a bus, getting away in the front of this momentum trade. But markets are trading like everything is perfect right now. We're about to enter a tougher stretch seasonally into September. So we do think that there's some room for markets here to consolidate, given how strong that sentiment has been.
I hear what you're saying, that things are looking pretty pricey right now, especially when you consider some of the cross currents coming at this market. But Emily, what is an investor to do here? Because you think about the human psychology side of things. These facts have been true for a while. Markets continue to go up. It's painful to miss out on those gains.
It sure is. And we do want to participate, Katie. What we're looking at right now is just trimming those riskier corners of the market and redeploying those assets into high quality stocks. It's areas that can defend their margins. I think this morning was a great reminder that we're going to see some margin compression coming in. PPI coming in hotter than CPI suggests that companies are really struggling to pass higher prices on to the end consumer here. And we think that's a trend that continues. So we want to lean into companies that have the ability to defend those margins. We're looking at the quality factor. We're looking at things like return on equity. We want to be mindful of how much we're paying for future earnings growth at the same time. So we're looking at things like the PEG ratio, PE divided by earnings growth. And that's leading us to sectors like technology, communication services, industrials. They all score high on sort of this intersection between quality and managing the valuation risk that's inherent in a lot of parts of the market. S&P 500 growth index trading at a 50% premium to its long-term average. That's tough.
Do you play into then, you mentioned industrials, but cyclicals, I mean, do you play into stocks that are going to benefit with rate cuts, considering everyone seems to agree that we're going to get them whether we need them or not?
Yeah, I mean, I do think that that's a boost to markets shorter term. I think certainly after the jobs report and the pricing in of a more dovish Fed, that was benefiting risk assets very broadly. I think you've got to be careful with cyclicals, though. One of the things that we're watching really closely right now is the massive outperformance in European stocks, even though economic growth and earnings growth has been much less attractive than it's been in the United States. European financial stocks are on fire. You wake up every morning and European banks are rallying no matter what the data is. And that's another sort of technical momentum sentiment driven move. And we would trim into that strength. So we want to look into high quality. A lot of that's found on the growth side of the market. And we just want to be careful of some of those areas that have run simply on technical moves and sentiment.
European banks, hard to ignore, but plenty of American investors are. Emily, I want to talk a little bit.
I find it pretty easy to ignore them.
Yeah, American investors, American news anchors. But I want to talk a little bit about the bond market here and how that factors into what you're saying. Because, okay, it sounds like the stock market is really expensive. Maybe it's time to take profit in the riskier corners of the market, still participate. Where does fixed income factor in? How does that look on a valuation basis?
Yeah, I mean, we think it's mispriced. You know, bonds, stocks, as you mentioned, priced for perfection. And meanwhile, fixed incomes offering elevated yields that we would suggest really locking in here and building a return stream for years. What is happening right now in the bond market is investors aren't really sniffing out the disinflation that we see coming down the pipeline. Yes, tariffs have the potential to be inflationary. We're seeing some of that this morning, but we have to remember that the manufactured goods side of our economy is only about 10% of nominal GDP. Meanwhile, we are a services-based economy now, and the biggest component of services within inflation is housing or shelter. There are big changes happening coming online in ways we haven't seen in a long time. Demand is slowing in the face of unaffordability, untenable insurance costs, people that are worried about their jobs, which is reflected in the confidence survey. So we're watching home prices actually come down. We follow the Case-Shiller National Home Price Index closely. 4 months in a row that's been down. That is going to allow disinflation to set in. And bonds are ultimately going to start to sniff that out, but they haven't yet. So we would lock in that income and high quality bonds.
You know, I have a very intelligent and plugged in viewer who's writing in with a comment that I guess you're going to agree with, but he says, what if the E is wrong, right? PE is always used, but price to free cash flow is jumping higher because cash flow post capex is disappearing. What do you think about that?
Yeah, absolutely. It's a great point. And analysts are penciling in right now 14% earnings growth for 2026, which looks a little bit optimistic to us. On the other side, though, you know, PE stayed at about 22 times for several months now. And the reason for that is earnings have kicked in. The earnings engine in the United States is on, and that's a good thing. And it's a key reason that we're favoring U.S. assets over international. We like those earnings revisions moving higher. We think there's opportunities there. And if that can continue, then, valuations are not a catalyst for a big correction. It just means we're at a trickier starting point as far as equities go. So we want to be mindful of that. But again, continuing to invest in those U.S. companies that have innovation, better profit margins, and higher quality.
All right, Emily, that's a good place to leave it. Great to get some time with you. That is Manulife John Hancock Investments Co-Chief Investment Strategist Emily Roland. Meanwhile, you look at the S&P 500 trying to go green here, getting pretty close. The S&P 500 lower by just 0.1%. The NASDAQ 100, a similar story there. Let's talk about what's moving underneath the surface. We'll do that with Bloomberg cross-asset reporter Emily Greifeld.
Hey, Katie, shares of Coherent, a semiconductor company, are falling about 20% right now after the company's sales forecast came in slightly below expectations. Bloomberg Intelligence actually said that the forecast indicates an AI deceleration. The company also said it would sell its aerospace and defense business to Advent for $400 million. Citi analysts positive on that sale. They actually raised their price target on the stock, but this morning that's clearly not doing enough to boost shares. Bullish is a different story. That stock soaring, extending gains after it IPO just yesterday, raising $1.1 billion in that public debut. The shares actually doubled yesterday from the IPO price, and now the stock is up about 20%. This is a crypto company. They're a digital asset exchange operator and also the parent company of CoinDesk, a crypto news outlet. Really what we're seeing here is that optimism growing for crypto companies tapping into public equity markets to fundraise. We just saw in June stablecoin issuer Circle going public, and now we're seeing that bullishness, you could call it, continue with this IPO here. Again, those shares up for a second day. Finally, Tapestry, this is the parent company of both Coach and Kate Spade, falling here after their EPS forecast missed Wall Street estimates. So the company said that it's facing greater than expected profit headwinds from tariffs and duties, with the earlier than expected ending of the de minimis exemptions being a, quote, meaningful factor here. Coach has been doing really well, particularly with Gen Z, but they said that they're expecting a tough year ahead for that Kate Spade brand. So we're seeing the worst intraday drop right now since March 2020, down 18%. It's paring those losses a little bit, but still deeply in the red, Katie and Matt.
All right, Emily, thanks very much. Bloomberg's Emily Griffeo from the Cross Asset Desk looking at stocks for us. Coming up, investor attention now turns to tomorrow's retail sales report. More on that data next. This is Open Interest. Now to high interest, to look at what's making headlines around the world. Deere delivering disappointing third quarter earnings and cutting its outlook as lower grain prices curb farmer spending. The company writing a statement saying customers remain cautious amid ongoing uncertainty. Cisco is sticking to a cautious outlook for the current fiscal year, even as AI sales begin to pick up. The CFO says the guidance assumes that current tariffs remain in place and exactly as they are now through the end of 2026. JD.com reporting better than expected earnings, the results getting a boost from government-directed consumer subsidies and an aggressive but costly drive into new arenas. And yet, the shares are down 4%.
Yeah, a little bit unintuitive there. We'll dig into that. But let's get into the health of the consumer. We'll get another read tomorrow when the retail sales figures are released. Let's break it down with Reed Pickert. She is Bloomberg U.S. economy editor joining us from Washington. Reed, great to have you with us. So this is for the month of July, a month that encompassed Prime Day, for example. Are we expecting to see that show up in the numbers?
Yes, we are. So when we look at the retail sales figures we're expecting tomorrow, economists are expecting a pretty solid gain. So the median estimate is for about a 0.6% rise from the prior month, but those forecasts range pretty widely. But the thought is that online promotions like Prime Day, which extended from 2 days to 4 days this year, as well as other online promotions seen by retailers like Walmart, really helped drive spending in the month, as well as car sales. It was also a pretty solid month there as well.
So are consumers not that worried about their job? I think the main question is on the labor market when you look at these numbers, right?
So I think this is kind of a key moment because we're thinking about a consumer that either A, is picking back up steam again, potentially after pulling back in the first half of the year amid all of this economic uncertainty, or this could be kind of a one-time boost in terms of consumers looking for ways to save money and see deals as they confront this kind of concerning outlook in terms of their jobs and this slowdown that we've seen. So it's kind of a toss-up on how to read that, but we are looking forward to hearing more from the retailers in the coming weeks in terms of what they're hearing from their shoppers and what they're seeing in terms of what folks are actually buying. Are they buying kind of more discretionary goods, which would support this idea of, consumers being more optimistic, or are they, taking these opportunities to buy things like cleaning supplies and household items that they need? And we're looking at this as an opportunity to get those for a cheaper price.
All right, Reed, thanks very much. Bloomberg's Reed Pickert will be covering all the news for us tomorrow. Turning now, though, to retail earnings, Tapestry shares have dropped. The owner of Coach, as well as Kate Spade, missed analysts' forecasts, mainly because of the latter and its annual outlook for a key profit metric. We're joined for more by Emily Cohn, who leads our coverage of the U.S. consumer here at Bloomberg. And I guess Kate Spade is the real underperformer here, right? Coach seems to be still doing double-digit sales growth.
Yeah, Coach is a great example of what we call attainable luxury. It's not super expensive. It appeals to that middle-income consumer. Even the higher-end shopper might be trading down to Coach. So that's why we're seeing Coach up 13%. But the business as a whole is struggling to grow its bottom line, and we're seeing its tariffs. It's a write-down of Kate Spade. It also took on a lot of debt to finance a Capri deal, which obviously fell through. So that's why we're seeing that stock down.
It's interesting. We saw Romain Bostic. He did a pen and paper interview with the CEO of Tapestry, and she said that they've been trying to build momentum in Coach over the past 5 years. And with Kate Spade, we're learning a lot from Coach. So do we see this company trying to map over that experience, and why hasn't it actually borne fruit yet?
That's a really good question. I think Coach is just having a moment. We have a great story today on bag charms. That Coach is leaning into this
bag
trend.
charms.
Labubu is part of the trend.
Kava has one. Have you seen the Kava bag charm? It's like a little pita.
Yeah. So this is a really interesting trend. People might not be spending $5,000 on a new luxury tote, but they're leaning into these charms, these attainable luxury that make them feel like they have something new, that they're trendy. And
you're talking about adults here, right? Adult purse owners are putting charms on them.
Mm-hmm.
Yeah.
You see it on the subway. You see it on Bloomberg.com today.
I can't escape these Labubus. I don't know. They're everywhere. I don't know if you've seen them. They're kind of creepy.
I've bought one.
Oh.
Yeah.
For an adult?
In Italy. Turned out to be fake.
Where do you put it?
I don't know. I just gave it to one of my daughters. You know,
Sweet.
I didn't put it on my purse.
Okay.
If that's what you're asking.
I was wondering.
Yeah.
Birkenstocks.
Yeah.
Let's switch gears a little bit here and talk about feet. Birkenstocks also reporting earnings. What was the reception like?
So I think Birkenstock raised prices. I think there's a good analyst quote in our story that says it's one of a handful of must-have brands that retailers have to stock to be successful. And I think part of that is this value proposition that you get from Birkenstock. Yes, they're a little bit pricier than your average flip-flop, but you know you're getting a shoe that's built to last. You know that it's a shoe that's built for comfort, and it's supportive. And I think that value prop is becoming increasingly relevant here when you're talking about, as Reed spoke about, this strapped consumer that's looking for value.
Also something to wear to your next fish show. You know?
I don't know. I see everyone of all generations and genders and music tastes wearing Birkenstocks nowadays.
Yeah. It's pretty surprising to me that, and I know this has been going on for a while, that this shares trade in the U.S., right? Because it's such a German company. Such a German thing to wear Birkenstocks as your house shoe.
That was a very fun IPO. But the fun continues next week because we have more retail earnings in the form of Home Depot, Lowe's, not retail apparel that we're talking about, but we also have Walmart next week.
Yeah. So we'll be looking for any signs of consumer strain and also how these tariffs are showing up or not showing up in prices and how that's affecting the consumer. Walmart has pulled ahead of Target in terms of this value war, this war for the strapped consumer. Walmart is, helped by its scale. It definitely is offering the biggest discounts. Target has sort of lost its edge. It's still reeling from a boycott. We'll be looking to see if that boycott showing up in its sales figures this next week. And last week we saw restaurants starting to see signs of penny pinching. McDonald's called out people cutting back on breakfast. We're going to look for signs like that, any signs that consumers are pulling back on their spending.
It's hard to overstate how big and important Walmart is. It's an $800 billion market cap company. I saw a joke on Twitter this morning.
Over 2 million employees.
It's crazy. I mean, it's such a huge employer, and a lot of people rely on Walmart. I saw a joke on X this morning. I can't remember who posted it, but basically it was like, okay, if Walmart beats, that's bad news for the economy, and if Walmart doesn't do well, that's bad for the economy as well. There's so many different ways you can read into Walmart numbers every quarter.
And Target is supposed to be a little bit more upscale, though, right? Because Target used to have these partnerships with like Lily Pulitzer, and people pronounce it Target, like Jacques Penney.
Yeah. I think Target's kind of lost that edge, and Walmart's really leaning into that in the past couple of quarters. We've heard them talking about the higher income, the more affluent consumer coming to them. I think that's because of their merchandise. Also, their grocery business has been huge. So Target has definitely lost that affluent consumer edge to Walmart.
Yeah, and Walmart benefits, of course, from that trade down to Emily. Great to speak with you. Great preview. That is Emily Cohn of Bloomberg News. And still ahead, more on the retail and the consumer. We'll speak with the CEO of the RealReal following the company's solid second quarter earnings report. That conversation coming up soon. This is Open Interest.
All right, take a look here at the S&P 500 on the move screen with the Bloomberg terminal. We did almost climb up to gains in this session. We're down a little bit from the all-time highs that we closed at yesterday. But as Katie mentioned, the breadth is really bad. More than 400 stocks are down and only 100 are gaining. The gainers include Amazon, Microsoft, and Nvidia, and that is what would normally bring us higher. Nvidia obviously really moves the needle. But on the downside, you see Apple, which has dropped since the session started. Deere, which disappointed with earnings. And Tesla, which is so volatile, you never know why it's moving. If you take a look at the breakdown of groups, almost all of the industry groups are down. Materials, real estate, and energy leading the pack. Only communication services, that's Amazon right now, is gaining, I guess, consumer discretionary as well, rising a little bit. Coming up, over 600 collectible cars are ready to be auctioned off at the Del Monte Golf Course in Monterey, California. We're going to talk to Mecum Auctions. As the portfolios of some of the world's richest continue to climb, so does their discretionary spending power. And they can use that on some of the most expensive cars in the world that will be auctioned off beginning today at Mecum Monterey 2025. An estimated 600 cars will be available, including American classics, hot rods, motorcycles, and at least one Ferrari GTO that is white, which is extremely rare. Dave Majors, the CEO of Mecum Auctions, joins us now from the Quail at Monterey Car Week. And Dave, let me ask about, these risk assets, the stock market at an all-time high, Bitcoin trading at $125,000. How much does that drive the bids that you're getting for cars like the white Ferrari GTO?
Well, I think what we're seeing in the markets today is a little bit of the relief from the anxiety that we've seen in the collector car market since March when the tariffs were introduced, and then, of course, turmoil over the passage of the big, beautiful bill caused issues, geopolitical issues. The market's been in a bit of a doldrums, the collector car market, since March. And I think from what we're seeing here at Monterey with the talk that I've heard the last couple of days, maybe we're past that anxiety and we're ready to jump back in with both feet in some very expensive collector cars here at Monterey.
What are the prized possessions that you're selling off this weekend, and what kind of prices? Oh, I like that Daytona. What kind of prices do you expect?
Well, I think prices have been relatively stable. I think Monterey is going to be the bellwether to tell us whether prices are going to continue to climb or if we're going to stay relatively flat for some period of time. It seems like, at least here at Mecum Monterey, Porsche is the word of the day. We have, I think, 28 to 30 vintage Porsches here, 20 vintage Ferraris. I think there are about 20 vintage Mercedes. So it's pretty much across the board. And of course, this is Mecum Auctions. This is muscle cars. So we're led by Corvette. And I think I counted 38 Corvettes, either vintage, custom, or late model, that are here at Monterey as well. And of course, behind me, the 1962 250 GTO, a Ferrari, not for sale here at Mecum Monterey. It's on display. We unveiled it yesterday, and that car will actually be going to our Kissimmee auction, the world's largest collector car auction, in January of 2026.
Wow. So you can't get it today, but you can get it in January, it sounds like, potentially. Dave, I am curious, you just walked through some of the highlights there. Are there any makes or models that you think are undervalued right now?
Well, I think Ferrari's been, as I said, a little bit flat recently for the reasons that I mentioned. I think Ferrari is always very popular here in Monterey, and I expect to see some Ferrari prices that maybe exceed some records. We have a 1951 212 Ferrari Export Barchetta that I think will bring premium dollars. Just a beautiful car.
I wonder about EVs, and my good friend Hannah Elliott, who co-anchors my podcast for me, Bloomberg's Hot Pursuit, has posed a question that I think is really important. Are EVs going to ever be collectible? I recently drove a Dodge Charger EV that I had a lot of fun with, but obviously they're going to make a bunch of them, and no one really wants to buy them right now. Do you think EVs have a future in collector car auctions?
I think everything becomes collectible. I don't know that it's, going to be as popular as, say, 60s and 70s American muscle cars, but there will be that subset of people that are interested in EVs. I think it's interesting that, the buzz in EVs the last couple of years was very strong, and as you said, you drove a Charger. That was, Dodge had pinned some hopes on some EV muscle cars. I think we're seeing the manufacturers start to back off of that now. So I'm not sure that the popularity of EVs is near as strong as it was maybe 2 years ago.
Yeah, I think we can all agree that was a very silly strategy from Dodge. But I'm here to tell you that the Charger EV is a lot of fun to drive, and I love the way it looks. It kind of takes the muscle car, the 60s look of the Challenger, and brings it into what would be the 70s. In those terms, Dave, moving forward in time, do you see that at your auctions as well? 60s and 70s, the golden era of muscle cars is what you and I love, but kids like, maybe Katie, and I mean, she's not a kid, but people her age who are younger than us may be more interested in cars from the 90s or the early 2000s. Is that really showing up in your stock?
It is starting to show up where you see, like Fox body Mustangs from the 80s becoming very hot. A lot of the 90 cars, particularly cars that were made popular in movies, are becoming very popular. And we're seeing a younger demographic that is starting to come to our auctions that are interested just in those kinds of cars. And we had a couple of Nissans a couple of weeks ago in Harrisburg, Pennsylvania, brought great prices and real spirited bidding. So there is a group, a younger demographic group that are interested in the cars that they grew up with, just like I might be.
I'll end on the kind of same theme that I started on, Dave, which is you're at Monterey Car Week, which is arguably the biggest, at least one of the biggest events for gearheads like us of the year. And now that we're past those tariff fears that you mentioned of, April 2nd, Liberation Day, do you expect a big showing? Are a lot of people going to be there to see the most important cars that the world has to offer?
Yeah, what I'm seeing is, as you mentioned, the S&P, the NASDAQ, I think, the Dow may be set to set a new record over 45,000. Gold has retreated $100 an ounce. All of that would say we're either getting more comfortable with the turmoil or we believe the turmoil's over. But at any rate, I think the financial anxiety that we've seen since March in the collector car market has subsided somewhat, and I think we're going to see that here in Monterey this week.
All right, Dave, great to get some time with you. Really appreciate it. Dave Majors there of Mecum Auctions at the Quail in Monterey for Car Week. I'm really bummed that I couldn't go to it, because that is like the event. All of the CEOs are going to be there. The whole industry gathers at Pebble Beach.
Is there.
Hannah Elliott is there, my partner in crime on my podcast. Did I mention that I have a podcast?
Yeah, it's called
Hot Pursuit. And it's really just about the cars that we love, the cars that we drive, and the people in the industry. So, for example, last week we spoke with Mark Royce, the president of General Motors. On Sunday, we're going to talk to Jim Farley, the CEO of Ford.
That's going to be a good conversation.
I'm really looking forward to it. And it's mostly, it's not as much about the business, like, hey, are you guys boosting free cash flow? But it's about, like, hey, are you driving the new Mustang GTD? Did Corvette just set a new record at the Nürburgring?
It's definitely for car people. I have listened to it, though, and it's nice language immersion because, I like cars, but I don't love cars. But really interesting conversation with Mecum Auctions right there. I like that you tied it in to the wealth effect that we're seeing in the equity market. And speaking of the equity market, we're just about positive on the S&P 500 right now, pretty much unchanged. We already got there when it comes to the NASDAQ 100, now higher by about 0.1%, really shaking off that hot PPI reading that we got this morning. Can't say the same for the bond market, though. You can see yields rising a little bit, people selling long-dated debt, the 10-year Treasury yield higher by about 3 basis points. But let's take a look at some of the single stocks moving this hour. We'll do that with Bloomberg cross-asset reporter Emily Griffeo. Emily, what's up?
Hey, Katie. Well, I'm watching shares of Deere right now. That stock is falling in its biggest intraday drop since 2022. It's down over 7% right now. The tractor company trimmed its net income forecast for the full year, citing lower grain prices curbing farmer spending here. The company said that, quote, customers remain cautious amid ongoing uncertainty, and CFRA noted that tariff uncertainty has made farmers cautious in their spending decisions. I'm also watching shares of Cisco, the IT networking company. Shares have kind of been oscillating between gains and losses this morning. Right now, it is down slightly in the red. They gave a cautious forecast for the current fiscal year, even as sales from AI projects do begin to pick up. For Cisco, I thought it was interesting to look at what the street had to say. Vital Knowledge said investors seem predisposed against tech at the moment, perhaps reflecting some of that selling pressure here, given macro shifts and growing anticipation for Fed easing. Perhaps you'd rotate into maybe more unloved sectors, move out of tech if we do see that additional Fed easing. Finally, I'm watching shares of JD.com. The ADRs for this Chinese e-commerce company are down about 3% right now, despite the fact that they did report EPS and sales that beat estimates. But it is a competitive space when it comes to e-commerce companies in China. You have Tencent, you have Alibaba outperforming JD.com on a year-to-date basis. And Bloomberg Intelligence also pointed out that the operating profit miss highlights that competitive pressure. And they also noted that JD.com posted an unexpectedly large food delivery loss, which wiped out all of its retail profits. So maybe people pulling back from food delivery, Matt and Katie.
Well, and look, that'll be interesting to see if that plays through with Amazon as well, because it's an expensive business to get into, right? And now they're expanding, Amazon is, to 1,000 cities.
That's right.
All right.
Yeah, I'm
very cool.
Very fascinated by that news. Emily, great roundup. That is Bloomberg's Emily Greifeld. And coming up, a retail turnaround story. The CEO of the RealReal joins us next. They reported earnings last week, was welcomed with open arms by the stock market. You don't want to miss this one. This is Open Interest.
This is Open Interest, and you are looking at a live shot of the principal room. Coming up on Bloomberg Tech, an interview with the CEO of Cisco, Chuck Robbins.
Let's turn back to retail now and focus in on luxury, and specifically the luxury resale market, because while other big brands are watering down their outlooks, earlier this month, specifically last week, I believe, the RealReal delivered a second quarter beat and boosted its revenue guidance for the full year. Here to tell us how is President and CEO Rati, Sahi, Levesque. Great to have you back with us. What gives you the conviction, the confidence to actually raise your guidance right now? Because it seems like that has been a little bit of a rarity in this earnings season.
Yes, for sure. I mean, I mentioned on earnings, it was definitely a breakout quarter for us. It's now 5 consecutive quarters that we've delivered revenue growth, double-digit revenue growth. A few things are driving that. Resale is becoming mainstream. That's one. Number 2, it's direct actions that we've been doing. We've reinvested in marketing across the funnel, especially top of funnel. And then our growth playbook, meeting the consignor where they are. So that's sales, marketing, and retail really coming together to drive supply. I've talked about before in your segment, we're a supply constrained company. So really focusing on supply coming in through our sales teams, our retail locations, which bring in many new consignors, and some of the product initiatives that we're delivering that really is resonating with our consumer.
Well, let's talk about the RealReal and situate your company in the economic environment, because you could make the case that, okay, inflation is still a problem for the average consumer. They're looking for nice things, but maybe at a little bit of a reduced cost. Is that helping your company and people coming to your site looking for bargains?
Well, that's the interesting thing about our business. Our business model is pretty flexible in that way. We're a value play at the end of the day, right? It's that intersection between value and luxury. And then you're getting mostly one-of-a-kind items on our site. You can't find these items anywhere else. But we let the market set the price at the end of the day. It's what are people willing to pay for it. You have seen some prices go up in the primary market. For us, we look at our data, we look at implicit, explicit behaviors as far as items, what's out of favor, what's in favor, and our pricing algorithms adjust accordingly. They're pretty dynamic in that way.
Is it Is your business aimed really at women? Because I want to see like the real McCoys, bomber jackets or Aero leathers or samurai jeans or Iron Heart, and I don't find that much of that stuff on your site.
Yeah, we're about 75% female, a quarter male as our consumer. We've got a lot of mostly millennial Gen Z consumers. It depends on the item that you're looking for and the coast. We actually sell a lot of jewelry to men. That's a big growth area for us, as well as handbags.
You mean like necklaces?
Probably watches, right?
Watches, many Rolexes, lots of one-of-a-kind rare finds, chain necklaces, briefcases, handbags, shoes is a big one as well.
Shoes are a big one as well. So Matt, just broaden your horizons a little bit there. I do want to talk a little bit about the point you made that this is a supply-constrained business. You rely on people coming and selling their items with you, and of course, people then buying it on your platform as well. How does that work exactly? How do you bring in people to first be aware of the RealReal and then actually want to sell their items there?
Yeah, 10 years ago, I would say there was definitely a stigma around resale. People thought of, secondhand as, not as interesting. And now it's much more a badge of honor, led by millennials again and Gen Z especially. Most of them now will buy secondhand even first. So a lot of it was educating the consumer at the beginning and really disrupting the space, getting them to understand what holds its resale value and what doesn't. Stores is a big way. It's a nice branding opportunity for us to see what secondhand could look like. And then again, just educating them, saying something like shoes sometimes don't hold their resale value, Birkins, jewelry, these types of brands do. And that flywheel then that, our consignor then gets their first paycheck and it becomes really interesting for them. And then you see them change their shopping behavior. So now they're looking at the secondary price. What is the market willing to pay for something before they even purchase it in the primary market? So they're checking our pricing first. Think about it like the Kelley Blue Book of pricing. They're checking that first to see if they will go ahead and make that purchase in the primary market.
Well, it's interesting. Most people think of the RealReal as a website, but you have started opening up stores. For example, you have a location on the Upper East Side that I've been to. What's the strategy there when it comes to your physical footprint?
Yeah, we are a digital first company, but the stores are a nice, like I said, branding moment. They bring many new consignors in. We see this halo effect happen when we open a store. For example, recently we just opened up Houston and we saw over 90% new consignors come in through those stores. So nice way to drive new. We also saw over 50% of shipped retail value supply coming in grow in the Houston market. So it's still a new behavior. I said resale is becoming mainstream, but we still have a long way to go. 50% of our consignors have never consigned anything before. So again, it's just getting people used to it, getting people to realize that they do have things in their closet. We're launching something later this year called My Closet, where the consignor will be able to catalog the items in their closet to know how much things are worth. Do they want to trade in? Do they want to trade up? Do they want to keep the item? So again, continuing to educate them.
All right, Rati, great. Get some time with you. Thanks so much for joining us. The RealReal CEO, Rati Sahi Levesque, talking to us about her growing business. Coming up, President Trump signals a tough stance with Russian President Vladimir Putin, but also sets expectations pretty low ahead of tomorrow's meeting. This is Open Interest.
Will Russia face any consequences if Vladimir Putin does not agree to stop the war after your meeting on Friday?
Yes, they will. Yeah.
What will those consequences
There will be consequences.
Sanctions, tariffs?
There will be very severe consequences. I would say the second meeting, if the first one goes okay, we'll have a quick second one. I would like to do it almost immediately, and we'll have a quick second meeting between President Putin and President Zelensky.
That was President Trump sending a warning to Russian President Vladimir Putin ahead of the summit tomorrow. Trump telling Fox Radio today, there's a 25% chance that the meeting is not successful. Bloomberg State Department and foreign policy reporter Eric Martin joins us now to talk more about this. Eric, so it does seem like the president is setting a pretty low bar for this, at least for this initial meeting tomorrow.
That's right, Matt. I just came from the State Department, and I asked Secretary of State Marco Rubio at an event there about some of the details about things that we'd heard mentioned previously in terms of potential land swaps, whether the lines of the current battle lines would be the final line potentially in a peace deal. And what he said is basically that these are details to get to later, but that this is a kind of a feel-out meeting, as President Trump has said, kind of downplaying expectations for getting really into details, but just a chance to take the pulse of President Putin and see where there might be room for agreement. Of course, Secretary Rubio also underlined, as President Trump has said, that any agreement ultimately will need the agreement of Ukraine, the other combatant in this war, and the country that's been defending itself against Russia's invasion. So this is looking at it as a first conversation to lay the work for a potential summit sometime soon, or meeting sometime soon, between Presidents Putin and Zelensky.
Right. And to that point, the president also said in that Fox interview that the outcome of a successful summit with Putin would be a second meeting, one between Putin and Ukraine President Volodymyr Zelensky. And to that point, how does Zelensky factor in? Of course, he's the elephant in the room in this talk.
Absolutely, right? That's the missing protagonist in this conversation tomorrow. And so that's, I think, one of the reasons why we've heard President Trump, Secretary Rubio, and others talking about this being a feel-out meeting, or a meeting that's an opportunity. Remember, this doesn't happen often. This is the first meeting that we've seen, a bilateral meeting between President of Russia and United States President since 2019. The first visit by President Putin to the United States since 2015, and the first bilateral meeting on American soil since 1988. So this is really something to lay the groundwork for future conversations, rather than looking at and approaching it from the administration's point of view as an all-or-nothing kind of deal tomorrow in Alaska.
All right, Eric, really appreciate your reporting. Bloomberg State Department and foreign policy reporter Eric Martin coming to us from Washington ahead of tomorrow's summit. Let's get a check on these markets as we wrap up the second hour, essentially, of trading. We're looking at a flat S&P, although we still have pretty bad breadth.
Yeah, it's remarkable. You take a look at the breakdown of the S&P 500. Bad breadth. It's gotten a little bit better. You now have 115 names or so in the green, fewer than 400 in the red. And if you take a look at the sector level, previously when I checked this at 9:30, you only had one sector in the green. Now you have 5. So it's going to be an interesting trade through the end of the day. And you and I actually will be closing these markets on Bloomberg Television, so we'll get the full picture.
Oh, man, we get to talk to Ken Rogoff today.
Really great.
I am pretty excited for the close. Katie and I will be back for that tomorrow on this program. Callie Cox of Ritholtz Wealth Management joins us, as well as Joanne Shu of the University of Michigan, plus the CEOs of Bentley and Lamborghini.